Hi, this is Mike Larson for Money and Markets TV. For months now, I've been warning you about exactly the scenario we're seeing in the markets right now. I saw it coming because I recognized that the US economy, the European sovereign debt crisis, and the credit markets were all bad and getting worse. And I knew that both fiscal and monetary policymakers were out of bullets. They're unwilling or unable to print and spend hundreds of billions of dollars more in funny money to artificially prop up the markets. That's why I've been urging you to sell most of your stocks, dump risky bonds, eliminate your real estate exposure, and even take offensive action, adding inverse ETFs that rise in value when stocks fall. Now, this call didn't make me popular, and a lot of Wall Street pundits disagreed with me. They thought Ben Bernanke would use this week's Federal Reserve meeting to pull some magic pony unicorn out of his hat to boost the economy. But just as I expected, the central bank instituted a debt swap to drive down longer-term interest rates. And as I expected, disappointed investors dumped out of their equity holdings, driving the Dow Industrials down nearly 700 points in 2 days. But let me go back to that Fed meeting for a minute and discuss what policymakers actually did and didn't do. First, they admitted that the economy stinks. They warned of, quote, continuing weakness in overall labor market conditions, called the housing market depressed, and said there were significant downside risks to the economic outlook, unquote. I couldn't have said it better myself. Second, the Fed instituted a program similar to one tried back in the 1960s, called Operation Twist. They're going to sell $400 billion of short-term treasuries with maturities of 3 years or less, and buy an equivalent amount of longer-term treasuries that mature from between 6 years and 30 years. And third, the Fed said it will continue to reinvest the proceeds of mortgage and treasury securities it already holds, and reiterated its pledge to keep interest rates low through 2013. But these moves are just a whole bunch of nothing. Short-term interest rates are already near zero, and long-term interest rates are the lowest they've ever been for key products like mortgages. Yet despite all that, practically no one is building or buying homes. So why would even lower interest rates make a difference? The answer? They won't. Then there's the whole issue of flattening the yield curve, driving long-term rates down while keeping short-term rates steady. That sounds all well and good, but it's the kiss of death for the banking sector, which relies on a steep yield curve to make money. No wonder why 3 Fed policymakers dissented again over this ludicrous plan. And most importantly, the Fed is not printing fresh cash like it did with QE1 and QE2. It's keeping the overall balance sheet steady. That means all those people still using their 2010 playbook, buying tech stocks with price-to-earnings ratios of 100 to 200 on the theory that more liquidity lifts all boats, are going to get crushed. It's becoming obvious to everyone, as it's been obvious to me for a while, that the Fed is out of bullets. And that realization could be the start of the market crash that will send the Dow to 7,000, as I've predicted. Now, if you've taken my previous warnings to heart, you're well prepared for this turn of events. But if not, you need to take immediate steps to protect your holdings against another leg down in the markets. That means sell your economically sensitive stocks, including transportation, retail, and materials shares, sell any remaining banks, brokers, and builders, as well as riskier junk bonds and REITs. And please get rid of any exposure you have to the European markets, stocks, or currencies. Then once you've done that, consider going on the offensive with inverse ETFs that target vulnerable asset classes and market sectors. I'm telling subscribers to my Safe Money Report exactly how to do just that. For Money and Markets TV, I'm Mike Larson. Thanks for watching.